Insurance is supposed to protect people from disaster. But more and more, it also decides who can afford to feel safe before disaster even happens. That is a very different kind of power. That is why insurance has become one of the new wealth filters. It separates people not only by what they own, but by how much risk they can push away. It does not always look like status. It looks boring: premiums, deductibles, copays, exclusions, renewal letters, and fine print. But boring paperwork can still decide very serious outcomes. But boring is exactly how powerful systems hide. A luxury watch shows status loudly. Insurance shows status quietly. One person has protection, options, and room to recover. Another person has fear, delay, and a bill they cannot absorb. The same event becomes two different lives. That difference is not just personal finance, it is access. The strange part is that insurance is sold as peace of mind, and when it works, it really can be peace of mind. Good insurance can stop a bad month from becoming a ruined decade. That is the honest reason people need it, and the honest reason losing access to it is so dangerous. So this is not an anti-insurance video. The problem is what happens when the price of protection rises faster than the household's ability to carry it. Protection starts sounding normal and feeling elite. At that point, insurance stops being just protection. It becomes a test. Can you afford the premium? Can you afford the deductible? Can you afford the out-of-pocket maximum? Can you afford to use the thing you already pay for? Those questions turn protection into a financial exam. That is the wealth filter. Start with health insurance, because this is where the logic becomes painfully obvious. Care is not only a medical system, it is also a pricing system. KFF reports that about 2/3 of adults are worried about affording healthcare costs for themselves and their families. That is not a fringe anxiety, that is mainstream household stress. That worry includes insurance premiums, out-of-pocket costs, office visits, and prescription drugs. In other words, the anxiety is not only about getting sick, it is about paying for the system around sickness. So even having insurance does not automatically mean feeling secure. A card in your wallet is not the same thing as affordable care. This is one of the most misunderstood parts of modern insurance. People think the uninsured are exposed and the insured are safe. But many insured people are only conditionally safe. Safe if the provider is in network. Safe if the deductible is already met. Safe if the claim is approved. Safe if the bill arrives as expected. A lot can go wrong inside the word covered. That is a lot of ifs for something sold as security. And those ifs are easier to survive when you have money. If you have savings, a deductible is annoying. If you do not, the deductible is a wall. Same policy language, totally different life experience. If you have flexibility at work, appointments are manageable. If you do not, care costs time and wages too. If you have knowledge, you can appeal, compare, and question. If you do not, the system intimidates you into silence. Confusion becomes part of the business environment. So insurance does not only filter by money, it filters by time, literacy, patience, and confidence. That is why the wealthy often experience healthcare as navigation. The poor often experience it as threat management. Both are using the same system, but not the same version of the system. Now move to home insurance. The Dallas Fed reported that home insurance premiums nationally rose about 70% from 2019 to 2025. That kind of increase changes household math, not just household mood. That is not a small background increase. That is a major household shock. Rising construction costs, climate disaster risk, and reinsurance costs have all pushed pressure upward. The household sees one premium, but behind it sits a much larger risk market. And again, the cost does not hit everyone equally. A wealthy homeowner may grumble and pay. A stretched homeowner may start falling behind. Dallas Fed research also connects rising insurance premiums to mortgage stress and delinquency risk. In plain English, the insurance bill can start shaking the mortgage. That means insurance can influence whether people keep the home they already bought. Think about how strange that is. The home may be affordable on paper, but the insurance attached to the home can change the whole calculation. Ownership becomes a moving target, not a fixed achievement. So the wealth filter is not only, can you buy the asset? It is, Can you keep insuring the asset after the world around it gets riskier and more expensive? That is a much harder long-term test than the purchase day suggests. That is a very different test. And in some places, the insurance market itself starts reshaping where people can live. Areas with climate risk, wildfire risk, flood risk, or storm risk can become harder and more expensive to insure. When protection gets expensive, geography becomes class sorting. People are not only choosing neighborhoods, they are choosing whether they can afford the risk attached to them. The rich can sometimes buy their way into risky beauty. Ocean view, mountain view, private space, high premium. Ordinary households may simply get priced out of the risk. That is, insurance acting like a quiet zoning law. It does not need a dramatic sign to change who belongs where, not passed by a city council, but felt in monthly payments. Now look at car insurance. The car itself is already expensive, but insurance can decide whether the car is financially livable. BLS tracks motor vehicle insurance inside the Consumer Price Index, and the category became a major source of household pressure after the pandemic. Drivers may not follow CPI tables, but they feel the renewal letter. Even when monthly changes cool off, households remember the level they are paying now. This is important because car insurance is usually not optional if you want legal, reliable mobility. It becomes part of the price of participating in normal life. If you need the car to work, then insurance is part of the price of income. That is the brutal part. The person with the least room in the budget may pay a high price just to keep the transportation that allows the budget to exist. That is a very efficient trap. And because insurance pricing uses risk categories, where you live, what you drive, your history, and sometimes credit-related factors can all matter. Some of that is actuarial logic. Some of it still feels like being charged extra for being stuck in a harder life. Both things can be true at the same time. This is the key tension with insurance. Risk pricing can be mathematically rational and socially ugly at the same time. A spreadsheet can make sense and still create outcomes that feel brutal. Companies price risk because that is the business model. But people live inside the risks they can afford to escape. A wealthy family can move, upgrade, install protections, pay deductibles, and self-insure small losses. They can reduce exposure before the claim even happens. A fragile household may have to accept the risk, reduce coverage, or go without. That is where insurance becomes a wealth filter in its purest form. The wealthy do not just buy nicer things. They buy less exposure. They buy the ability to turn disasters into inconveniences. That may be one of the least flashy and most important luxuries money can buy. Everyone else may experience the same event as a financial identity crisis. This is also why underinsurance matters. Underinsurance is not the same as being uninsured. It is having a policy that looks comforting until the real bill arrives and reveals the gap. High deductibles, exclusions, coverage limits, and narrow rules can all create that gap. The policy exists, but the protection is thinner than the marketing. The household technically has insurance, but still has too much exposure. That is one of the cruelest versions of the filter. You pay every month for protection, then discover the protection had a smaller door than you thought. And again, richer people can manage that ambiguity better. They can hire help, call specialists, appeal more confidently, or simply pay first and fight later. That last option alone is a privilege. A lower-income household may not have the time or emotional bandwidth to fight a complicated claim, so the claims process itself becomes another filter. The people with time, confidence, records, and help usually fight the maze better. This is where the system becomes almost comically administrative. The disaster is one problem. The paperwork after the disaster is another. Insurance is supposed to reduce fear, but it often replaces one fear with another. Will the system actually pay? That fear is quieter, but it is still real. That uncertainty has a price too. And this is not just about individuals. When insurance gets expensive, whole markets can change. Homes become harder to buy, cars become harder to keep, healthcare becomes harder to use. The same idea repeats across different parts of life. Risk starts deciding access. That is why insurance is a hidden layer of the two-tier economy. It decides who lives with backup and who lives exposed. The premium lane is not only nicer, it is safer. That is the part people often miss when they talk about luxury. The basic lane is not only cheaper, it is more exposed. And exposure is expensive, even before anything bad happens. It changes how people sleep, spend, move, and make decisions. So what should people actually learn from this? First, do not judge insurance only by the monthly premium. The cheaper premium can hide a painful deductible, weak limits, or exclusions that matter exactly when life gets ugly. Cheap can be smart, but cheap can also be incomplete. Second, think in terms of worst-case cash flow. Ask what happens if the claim is delayed, denied, partially covered, or paid after you already owe money. Third, keep documents. Photos, receipts, policy pages, claim numbers, and written confirmations are boring until they become evidence. Future, you may need proof more than memory. Fourth, review coverage after life changes. Not only when a bill gets annoying. A move, a new car, a child, a home upgrade, or a job change can change your real risk picture. Fifth, if a cost is rising, do not only ask, "Can I pay it?" Ask, "What risk am I actually transferring?" That question is boring, but it is powerful. Because sometimes you are paying for true protection. Sometimes you're paying for compliance, access, or the right to keep a mortgage or drive a car. That is still useful, but it is different from real peace of mind. Knowing the difference makes you less passive. The bigger lesson is that modern wealth is not just about owning more assets. It is about being less fragile when life breaks. That is a much deeper kind of wealth than looking successful in normal conditions. Insurance is one of the systems that decides how fragile you are allowed to be. The better your protection and buffers, the less one event can define your future. For the wealthy, insurance plus savings turns many disasters into paperwork. For everyone else, the same disaster may become debt, delay, stress, or displacement. The loss is not just the damaged thing, it is the chain reaction after it. That is why insurance has become the new wealth filter. It does not just ask whether you can survive risk. It asks whether you can afford to transfer risk away from yourself. That transfer is becoming more expensive. And in a world where protection itself keeps getting more expensive, safety becomes less like a basic promise and more like a privilege you have to keep buying, renewing, understanding, and defending